Hello, my name is Reva Bhalla, and today I'm joined by our global energy analyst, Matt Bay, to discuss the geopolitical implications of below $90 barrel oil. Matt, thanks for joining.
Good to be here.
So let's start with the supply side. What are the structural factors that you see underpinning what could be a very protracted slump in the price of oil?
So in the United States, which has really increased its production quite dramatically over the last 2 to 3 years, they've actually increased it by, the size of a lot of OPEC members, actually, about 2.5 to 3 million barrels per day. Today, it's sitting around 9 million barrels per day, which is third only to Saudi Arabia and Russia. So that growth, though, is still going to be happening. Even if the oil price stays in the $80 to $90 range that it is right now, there's still a lot of production that's still going to be quite profitable in the United States and still going to be drilling. We've actually seen the rig rates in the United States kind of stay the same. And that's really going to keep continuing to drive, maybe even adding another million barrels per day by the end of next year, which will continue to add pressure on the oil price. Outside the United States, we've had Libya come back in a big way thanks to solving some of their structural issues within the political landscape of the country that's kind of prevented oil exports earlier this year.
Well, yes and no, right? I mean, Libya, I would say, is sort of the swing player here in that, a lot of things have sort of come together to allow production to stabilize to a bit. And what did they increase from the beginning of the summer? What percentage increase are we looking at?
In percentage terms, about 300%. They almost tripled it. And you're right. I mean, the landscape there is very, very tense. The militants are still fighting each other. They still have the same kind of reasoning to, block oil exports. It's just that right now they're not doing that.
Yeah.
Now, going forward in the future, that's something that's probably going to continue. Libya's probably not going to sustain itself for, an eternity, obviously, or a very long time. And, in the future, probably even as soon as next year at some point, we'll start to see some of that oil at points fluctuate up and down.
And that's the key there, is to follow this, all the myriad militant factions in Libya. They're busy right now fighting each other. Haftar is leading a force in the east. You have this array of Islamists in Tripoli. And as long as they're focused on each other, that's good for oil, but that can flip very easily, especially as either side tries to undermine the other's gains in that wider battle. So Libya is definitely not a sure thing.
And it's also something that, investors and people who do watch the oil markets very closely are well aware of, and they do, keep very close eye on what Libya is doing up or down, and then, bet accordingly.
Okay. So what else on the supply side? Obviously, so you think U.S. production, that's going to continue proceeding apace. We're going to see we're at the 9 million barrel per day mark, essentially.
Mm-hmm.
Of course, now when we look at this coming OPEC meeting in November, all eyes are on Saudi Arabia. What is Saudi thinking?
Right now, Saudi's thinking that they don't really want to cut production. They've done it in the past, and they've actually gotten burned, especially in the 1980s. So in the 1980s, when they did it, in 1981, they were producing about 10 million barrels per day. Mm-hmm. By 1983, they dropped that to 5 million, but the oil price actually decreased. So they did not actually get the desired effect they wanted to, and they continued doing so and cut their production even further by 1985. And then the oil price kept on declining. And then they decided, well, this isn't working. And then since then, they've been really hesitant to actually decrease oil production.
Understandably so. So what exactly happened there structurally? Why did Saudi not get the result it wanted?
Well, in the early 1980s, a lot of the developing world was in the Latin American crisis, for example. Mm-hmm. A lot of the developed world was still in also an economic crisis, especially when the United States was in recession in 1981. And that kind of actually allowed overall oil demand to kind of be lackluster. Later in the decade, actually, you started to see production from the North Sea become a bigger impactor, and so overall supply was still increasing as Saudi was actually rolling back production. And now we're in a similar situation where we do see a lot of productions coming online in places like the United States, so they would have to do a pretty dramatic cut. But we are also in a state where places on the demand side of things aren't looking too good, like Europe, for example.
Well, right. So in Europe and Asia, still, these are huge economies. There's still a lot of demand there, but it's the rate of growth of that demand that's decreasing.
Exactly. So in the case of Europe, the demand has pretty much structurally been flatlining for about a decade or so, and the same is basically true in the United States. And that's something that's not going to be picking up anytime soon, and probably will never actually pick up ever. In places like China, though, the demand is growing, and that's actually what is something that is going to separate the 1980s from today. Today, the developing world is much bigger in terms of raw physical consumption. In the 1980s, they were still really, really small, and so when they were actually growing still, it just wasn't enough to move the register on the global demand side. Today it is.
Okay.
So that will at least allow us to not get into the scenario where the prices continue to fall dramatically.
So in this face-off between Saudi Arabia and U.S. shale, essentially, over price, who wins or is there a winner, really?
Well, it's not necessarily who wins or loses. Saudi Arabia, they have never been a gigantic exporter to the United States. The United States has always been a huge producer of energy, and it was as big as it is today. You have to keep in mind in the early 1980s and 1970s, where it was producing the same amount we do today. Mm-hmm. And the market that they're really concerned about is the foreign market in Asia, for example. So while they would probably appreciate shale not actually happening in the United States, they're much more worried about it actually spreading outside the United States, where it would then actually cut into the market that they really care about, like China.
Okay. And so another deadline coming up, Iran is looking toward its nuclear deadline November 24th, hoping for an easing of sanctions. They're at about 1.5 million barrels per day. But even if we do have the negotiations continue, which is what we expect, we don't expect a huge influx of Iranian oil into the market anytime soon.
It depends on when exactly that kind of a final deal that actually allows the removal of sanctions and the exports to actually increase. Yeah. But once we do have that deal, you would probably see a very slow increase over the next 6 to 12 months that would actually add maybe 500,000 to 1 million barrels per day, which would be significant, obviously. But the kind of plans that Rouhani has right now for the oil production is, in the longer term, increasing it to ungodly numbers like 8 to 12 million barrels per day, which is much more difficult.
Well, on the timeline that we're talking,
right,
yes.
Exactly. That's
and
the thing.
A complete easing of sanctions, that's not in the cards anytime soon. There's some big political constraints.
And also you have to, if you're considering how big Iran can be in the longer term, the 5-year time frame, it's also going to include how much interest there is on international companies actually going into Iran and helping to do the same thing that we've seen in Iraq. Right. And even in Iraq, they have not really dramatically increased their production since they reopened to Western investors in the late 2000 decade.
So I'm worried about Venezuela. Mm-hmm. So Venezuela kind of, strangely, they peg their budget to $60 barrel of oil, a Chavez legacy, essentially. Mm-hmm. But we know their finances are not doing well.
A lot of their off-budget financing for, buying off political patronage, that's not tied into that $60 per barrel. And they need that money as well in order for their political system to be successful. Yeah. And that is what pushes up their break-even well over $100 to something that is now, in jeopardy.
Okay. And so we're watching basically as Venezuela's finances become more severe and constrained in the coming year, the selling of their Citgo assets, that's going to be a big signal. Anything if they try to sell off their gold reserves. But we're really watching that security climate in particular, because if we see social unrest as a result of, peak levels of inflation, it all comes down to Maduro to manage that. All right, so let's look to our neighbor up north, Canada. So they're in a bit of a peculiar situation, especially when it comes to that price benchmark. What is Canada looking at in terms of their production?
Right now, it's around 4 million barrels per day. They want to increase that to 6 million barrels per day by 2030 or somewhere around that figure. And it's kind of a slow progression that's not like we're seeing in the United States, which is much more quicker. So it's, adding a little bit here as major projects that are 30-year projects come online. Mm-hmm. And those are the ones that are a little bit more in jeopardy. But the thing we have to remember when we look at Canada is because of the pipeline infrastructure is not as developed as they would like. There's a lot of capacity and bottleneck constraints that keep them from getting the international price of oil. So they have actually been sitting around $60 to $70 for a long time.
So how does Canada break out of that pipeline isolation, right? We have all of these different proposals on the table for Energy East or Keystone, and we know all the political constraints. What can we expect out of this pipeline debate between U.S. and Canada?
Well, it depends a lot on, midterm elections in the United States, and then also how much freedom Obama has going forward to pass Keystone XL, or potentially, if he does not, the 2016 election, if a Republican or what kind of Democrat comes into office. Those are the things that are still playing out, and that's something that's still probably going to play out over the next 3 years. In terms of the actual Canadian debate, is that a lot of that's going to hinge on their elections that are coming up in 2015, where right now the Liberal Party leader, Justin Trudeau, is actually has a little bit of a lead over the current Prime Minister, Stephen Harper, who is much more of a defender of the pipelines, and Trudeau is much more for something to the United States like Keystone XL, but is not as supportive of Canada-based pipeline exports like the Energy East one you mentioned, or any of the ones to the British Columbian coast.
But bottom line is it's going to take a while for the politics to sort out. In the meantime, that means a lot of stress on rail for transport for Canadian crude. Mm-hmm. All right, well, Matt, I think we're out of time. Thank you very much.
It's good to be here.
And we will have on Monday a series on the geopolitical implications of below $90 barrel oil that goes throughout all the regions origins that Matt Bay has led here at Stratfor. So we look forward to you checking that out, and thank you for your time.